Hey everybody, so welcome to part 4 of the JPM caller strategy and focus. So we're finally going to get to the good stuff here, gamma in focus. So I know some of you have been waiting for this because this is how it really starts to affect markets. We'll talk about second order Greeks probably in the next video. That should be the final video. So let's take a look here. This is what the position looks like. So you can think of these positions as two positions in one. I've turned this into the SPY just because I think it's going to be easier for the way we explain gamma and the other Greeks and the hedging process versus S&P, which is, futures and things like that. So let's just keep it to something that probably most people can follow along with. So we're going to turn this into a put spread caller on the SPY and 10,000 shares of SPY owned, and we're going to use 100 lots for the option position. So think of this as a put spread caller being two positions, right? So cover call long 10,000 SPY at 554, and you're short 100 of the June 30 expiry calls higher at the 581 strike. So 30 is the expiry date, not the strike. June 30 expiry calls at the 581 strike. So the 581 is the strike that is going to allow us to pay for the put spread. I've already gone ahead and done the math on these. Plus, you own the downside put spread. So it's a cover call, plus you're using the premium from that cover call to buy the downside put spread. So that's all this is, kind of a cover call with some protection to the downside. And so you've got the strikes here that are the 581 on the call side, and you've got the 530 and the 445 down here. So let's take a look. How would this look? So if I just owned the SPY outright at 454, which is where it closed, if it went down to 450, I would lose $1 million, right? Just over $1 million. That's a cool $100 on 10,000 shares. That's $1 million. Let's look at how the performance is when you own this put spread caller. So you can see that we're long stock. It can go down to the 530 put strike, and we're going to take part in that full loss at that point, right? So we're going to lose $24 on that, which equates to, you can see here, you're going to lose 239 grand. Now, I don't know where the extra 1,000 came from, but you're going to lose $240,000 on your long 10,000 shares that drops down $24 to the 530 strike. But below that, from 530 all the way down to 445, you are fully protected. So that's it. You only lose that $240,000 on your long SPY. And if you were to just own SPY on its own, you would lose $1 million. So that's pretty significant. That's a real benefit to this strategy. Now, if it continues down below 445, which is where our short strike is, then we continue to lose $10,000 per dollar below 445. So we're going to continue to lose money. Now, that would be an extreme sell-off, which isn't impossible. But for the most part, I think most people feel like, okay, down 20%, 25% is sort of in the realm of, maybe what you'd call reasonable, a little bit harsh, but maybe a little bit reasonable. Anything beyond that is starting to get into global financial crisis type scenarios, but you're still protecting 15%. Now, what happens to the upside? Well, you get up to that 581 strike and you don't participate in any more upside there. So this is really the P&L in the blue line here. This other line is basically a real-time P&L. What we're really concerned with is the blue line, which is at expiry. How does this P&L look like? Well, you're capped up here, you're protected here below a certain point, and then you continue down with the market below the 445 strike. Now, what we really want to look at today is what happens to the market makers who are taking these positions on, right? The clients are owning it. They're not doing anything to manage those option positions. But when this market takes on this position, what happens is there's a fairly large supply of options into the market. So positive gamma, positive vega, right? So the market makers are taking the opposite side. So if the client is selling the 581 call, the market maker is buying it. If the client is buying the 530 put, the market maker is selling it. And if the client is selling the 445 put, the dealer is buying it, right? So the dealer is taking on the opposite of those positions. And that's what's really going to matter, where we talk about how the tail and the dog and who's wagging who, and how these very, very big option positions can start to move markets around. So we'll talk about two things. There's the initial trade, and then there's maintenance after that. So, okay, so first of all, what we're going to do, remember we're in SPY now, not SPX. So we're going to flip this around. We're going to take out the stock because we want to look at things from the market maker's perspective. The market maker is just dealing with the options, and let's talk about how they're going to do that. So if we flip these positions around, meaning the 100 calls that the client is selling, the market maker is buying. See, they're buying 100. The 530 put that the client is buying, the market maker is selling. And the way out of the money put at the 445 level, that's what the fund is buying, right? It owns that downside protection way at the bottom there. Well, the market maker is buying that. So the market maker is doing the opposite of what the fund does. So what that does is they end up being basically long those upside calls, and they're short this put spread. And so what that does initially at the price where it's executed, basically where the market is trading at the time of this new structure, is going to supply the market makers with a whole bunch of Vega. Now, this is just 100 contracts. Imagine this times, hundreds and thousands. So massive amounts of Vega that the market makers are taking on, and they're taking on delta here, right? So this trade is going to give them a whole bunch of implied volatility, right? They're long options, they're long a whole bunch of gamma, and what that does is it usually it kind of compresses vol. So sometimes, may not always be the case, depends on what's going on in the overall market, but this is often a bit of a dampener to volatility. Everyone knows this trade is coming. They start kind of front running it, pushing down implied volatility, and backing off their bids. And so the market tends to be a little bit ready for this trade to come in. What it also does is it creates some long delta. So right off the bat, the market makers are going to have to sell futures in order to go delta neutral. So you'll notice that the fund is long 10,000 shares, but from a market maker's perspective, putting on this trade is going to make them long 5,600 shares. All they're trying to do is go delta neutral. They're not trying to go long this particular stock or go long net or short net. They're just trying to go neutral at this point. Now that's we're taking some liberties here. Generally speaking, we can consider the dealers and the market makers to be relatively pretty, we can generally consider the market makers and dealers to be regular hedgers, right? So they're not really trying to take big directional bets, which, I would do as a market maker. I would say, well, I'm being given this position, but I kind of like the stock, or the market. I'm going to lean into this, so I may not sell a hedge. But generally speaking, I think we can consider the really big liquidity providers as being, relatively good about hedging things. So what they would do is they'd come in and they'd sell 5,600 shares, and that would neutralize this position from a delta basis. We call that going delta neutral. So again, we see that this is going to have an effect on the market at the time of the trade of probably compressing vol just a little bit. When I say vol, I mean options pricing in general. It could have that effect, again, depending on what's happening out there, that may counteract that. But for sure, this is going to make them delta long. So if they were to buy this put spread caller, they would end up going along the market, right? Because this essentially is going to do better on the way up, right, from the outset. So they're going to sell and hedge. So that also creates a little bit of downward pressure on the market. So a bit of downward pressure on implied volatility, a bit of downward pressure on the market from these massive, massive deltas coming in. Remember, we're talking about, I can't remember what it is, 37,000 contracts or something like that of SPX that are coming into the market. And so that creates a huge amount of Vega for sale and a lot of deltas that these market makers have to sell out. So that is the initial effect from the trade. What it tends to be more important because that's kind of a one and done. What tends to be more important is what happens afterwards in what we would sort of call the maintenance phase, which is basically as this position moves around, the Greeks are going to move around as well. And this exists in time and space, right? So options, as we know, are multidimensional and they're going to change over time. They have this limited lifespan, so they're going to have non-linear behavior from a lot of these Greeks, right? In terms of delta and gamma and theta and vega, these things are going to change depending on how much time there is left to expiry, how far we are from strikes, is volatility being moved up or down? These are all very important things, right? Skew is going to make a difference. So lots of things, lots of moving parts here that can affect the management of this position. So let's quickly go over the way that a market maker would take on a long gamma position and what that means to them. Actually, right away, in the meantime, we are going to take a look at the gamma profile of this position. So this is basically what the market maker is taking on. We can see that at the time of the trade, which is basically right in here, right? 554 was it? We are basically, it's a positive gamma position. You can see that here. So anything above the zero line represents positive gamma. So right at the outset, they go delta neutral, and they now have positive gamma. That gamma starts to get more and more positive, gets larger on the positive side of things as you move towards that strike. And that makes sense. We're going to talk a little bit about that, how as we get closer to the strike, gamma increases towards the strike. Gamma is the highest at the strike. Whether it's negative or positive, gamma is the most extreme right at the strike price. And we can see here a short option position is going to create negative gamma. So look what happens when we start to head towards the short strike, which is right here. Now we're basically gamma neutral. We're not positive or negative. What's happening is we have a little bit of residual long gamma from up here, from this strike. We have short gamma down here. So it's kind of pulling our overall vega down, right? So our vega profile is starting to get a little bit more neutral. So let's type in 525, for example. Look at how our position changes. See, now we're just slightly short gamma and we're not long nearly as much vega. This long gamma, long vega profile has evaporate a little bit as we move further away from this strike that's giving us a whole bunch of gamma. So as long as the market, the theory is that in a positive gamma environment, it's not a theory. I used to live this every day for over a decade. This is what happens, right? If you're moving back and forth through a positive gamma position, you are having a little bit more fun generally because you're able to react to that by selling deltas. When it comes down, you're able to buy back deltas and you scalp this movement, right? You love gaps. You love when the market gaps up huge, you sell some deltas. You love when it gaps down huge, you buy back some deltas. If you bought those positions at a lower implied volatility, the market is now realizing a lot higher. It's got a lot more movement. So you paid very, less for the theta effectively, right? Your kind of theta bill isn't too bad, even though it's going to go up, but you're making vega, right? If the volatility runs up, you're going to make some vega, and then you got some theta to deal with. But you've already put money on the sheets because vega's kind of pushed up, your P&L, and now you're trading back and forth. That's a lot of fun. Those were the best times where you're back and forth trading massive gaps. That's a better position to be in my view. Now, as we kind of go through the short strike, we're short, we get shorter and shorter gamma until we start to get back towards that long strike way down at 445. So we start to get our gamma back. So get our gamma on, right? And now let's see what happens from a mathematical basis. And then I'm gonna show you how this can change over time, because time and space, movement in the underlying, and time passing is going to make a difference. And of course, movement in implied volatility, which again is another thing called VANA. So we're going to get into all those fun little Greeks that give us an idea of how P&Ls can move around in a fast-moving environment or slow-moving environment, as we're going to see from 𝐶harm. So, okay, so let's just put up some simple math here. Let's say the market makers are long those 100 June 30th, 581 was it? 581 calls. That's the strike. And at the outset of the trade, those calls are, let's take a look here. Okay, we're gonna try to make this as realistic as possible. Go out to our June calls. Take a look here. We're trading at 544 or whatever it is, and 554 rather, and the 581 call, there we go, the $9 that the fund sold is a 32 delta, right? So 32 delta. So what does this market maker have to sell at the outset? Well, they're long 10,000 shares essentially, right? Because 100 calls, 100 times 100 multiplier is the right to buy 10,000 shares. So this represents 10,000 shares. So at a 32 delta, right, we can say 0.32, we can say 32 delta, whatever you want to call it, you're going to go 10,000 times 32 equals 3,200 shares. Now, they're long the calls. So what do they have to do? Well, they have to sell those shares because this 10,000 shares is going to act very much like 3,200 shares, right? That's basically what your delta is telling you. Delta says these calls will act like 32 shares. That means this 10,000 times the 32 delta means the stock's going to act like 3,200 shares. So what do I need to do to neutralize that if I'm a market maker? I don't want risk. I don't want risk if it goes up or down. I want to neutralize this. Well, what I'm going to do is I'm going to sell 3,200 shares short. Let's just say that this is the only position they have on. Of course, this could be one of many, many positions. They may be selling out a long position of stock. They may be, I mean, there's all kinds of things they could be doing. Let's isolate this one put spread caller and try to treat it as the only position that they're dealing with. So they're going to sell 3,200 shares, which makes them delta neutral. Okay. Now, what if SPY goes to 581? Right? That's a pretty big jump from here. But let's say they don't neutralize in the meantime. SPY goes to 581. Well, let's take a look and see if SPY goes to 581. Oops. Actually, let's go up here. 581. There we go. We're going to leave this at 554. Okay, so at 581, these 100 calls on their own are going to represent a delta of 3,200. But that's oh wait, that's at the money. So at 581, we can see these have a delta. You can see 32 delta. So these calls are going to act like 33.98, right? Because they're about a 32 delta, 32, 33 delta. So they're going to act like long 3,300 shares. So if the market maker doesn't do anything, the stock goes up, great, good news. But if it goes down, that's going to cost them some money, right? So they neutralize by selling those shares, 3,200 or 3,400, whatever the delta tells them. Now, what happens if the stock goes up to 581? Well, now they're long 5,600 deltas, right? Remember, delta is not a linear relationship. It kind of starts out a little bit. It starts off when the strike is way out of the money. The delta doesn't react very quickly. You see that? It's not really reacting very quickly when the stock goes from here to here. It reacts a little more when the stock goes from here to here, right? This is the underlying movement. Goes up, goes down. So this call is way out of the money. But as we get closer and closer to the strike, right, as that market moves up, look what happens. This starts to accelerate in value. What does that mean? That's gamma. Gamma is the acceleration of delta. So we've got delta that's starting to accelerate in value because it's starting to get more at the money, right? It's more at the money. It's starting to have a really good chance of being in the money by expiry. So the formula is assigning a greater probability of this particular call being in the money as opposed to when it was way out of the money. The formula is just kind of saying, well, that's not really a threat. That call is probably not going to be in the money. But as the market moves up towards that strike, we have higher and higher gamma. We have delta starting to accelerate. And what that does is when it's at the money, it is now a 50 delta. So what does this mean? Well, the market maker's short 3,200 shares. The calls are long 5,600 deltas, right? Which is going to act like 5,600 shares. So am I overhedged or am I underhedged? I'm short 3,200 shares against an underlying option position that is starting to act like long 5,600 shares. Well, I'm underhedged, right? So what I need to sell is the difference between 5,600 and 3,200. So I'm going to sell. This is how I'm going to neutralize. How to get neutral? Easy. We're going to sell. What is that? 2,400 shares, right? 2,400 shares is going to get us to a short of 5,600, which is going to get us delta neutral again, right? Now these calls have more value to them. They've picked up price. They've picked up reactivity. They've picked up gamma. We're trying to lock in some of that gain. You're going to, on this move up to 581, you're going to lose a little bit of money on these short shares. But this gamma is probably going to get you to make money unless volatility gets crushed or this takes a long time to happen. If this happens relatively quickly, you're going to make a whole bunch of money on this. And you're going to lock in some of that money by selling 2,400 shares. Now I'm neutral again. Now, what happens? What if we keep going? Well, eventually these calls are going to be an 80 delta. And we need to be short 8,000 shares. But we're not. We're only short 5,600. So we're going to have to sell another 2,400, right? We're just going to keep selling. What's the maximum that we can sell? 10,000 shares. We can't be short more than 10,000 shares against these. This is 100 calls. It's only representative of 10,000 shares. If I short more than that, I'm just shorting them. Now, what happens if the market suddenly, some bad news comes out and we drop back to 540? At 540, let's say we're short 8,000 shares. We have a huge plunge. At 540, these are now, let's say, before they were 32 delta at 530 or so, 554. At 540, it's a little bit lower than it was before. So not only are they going to be lower than that 32, but time has passed. And we're going to talk about that a little bit because that's important as well. As time goes by, out of the money calls are going to lose their delta, right? Those deltas are going to start to go towards zero. In the money call deltas are going to move towards 100 as time goes on, as we get closer and closer to expiry, when those are when those are in the money versus out of the money. So now we're down to a 33 delta. Well, we're short 8,000 shares. We should only be short 3,200 shares, right? And in fact, I'd say these are probably going to be a 20 delta if this takes a while to happen, maybe lower. So we need to be short 2,000 shares. That means we can buy back 6,000 shares. So we've sold shares at 554, at 581, let's say at 605, when they were an 80 delta, let's say 610. Then the thing comes all the way back down, and let's say we start buying early. I'm not saying we wait till 540. Maybe on the way down, we buy at 570. We buy a couple thousand shares there. We buy at 550, and then we buy at 540. Let's say we buy most of it back, but we're short 2,000 against the 20 deltas. Now, as a market maker, I would look at that and I go, depending on how close I am to expiry, if those aren't really worth very much, let's say they're worth like 50 cents or 60 cents, I'm buying in all my stock. So that's one of the sort of art and science things that come into play when you're a market maker and you're kind of looking at things from a little bit more sort of market direction basis, then sometimes you're gonna lay it on the line. So if these are down to 50 cents or 60 cents or 70 cents, I'm just gonna buy back all my stock. Even though they say I'm long, they're worth a 15 delta, let's say, I'm just gonna buy them in, because the problem is when they're way out of the money, this is a conversation for another video, when they're way out of the money, they're soft deltas. They're really gonna collapse rather quickly. And I don't wanna get caught with my pants down being short deltas, short stock, against those calls, because on the way up, they're going to get crushed. And as we get closer to expiry, they're going to also have this charm effect, which is they're just going to start like losing. It's going to be kind of pushing a boulder up a hill. So that's when you're really way out of the money or way in the money. That's where you start applying a little bit of common sense to it. Even though, your delta says 90, those calls are probably acting like 100. So you want to be short as though they're 100 delta. So that's where a little bit of the play comes in here, to kind of stick handle your situation, and frankly play the ranges, right? That was always the fun part, playing the range on this gamma trading. Oh, I think we're gonna, we've come off really hard. I'm gonna go delta long because it's a cheap long, right? If I go delta long a bunch of calls that are 50 cents or 60 cents, that's a low risk long. So there comes a point when you're trading back and forth where you're like, well, I'm going to go long because I don't have much on the line. I'm not going to go long a 50 delta. There's a lot of money on the line, but I'm going to go, potentially. But 20 delta, 10 delta, 15 delta, when something's worth almost nothing, that's not risk, right? You don't want to be short shares against something that's worth calls that are worth almost nothing at that point. So, and especially if you've made money back and forth, you're going to risk a little bit of that money to really turn that into something special, right? That's where, I would have months where I'm up, 40, 50 grand, and, that's where I press. That's where you use that 50 grand to turn it into 400, 500 grand, because you're playing the swings, you're in tune with the market, you're starting to push deltas, right? You're leaning into deltas because you know that they're very soft deltas. But if the market does make a big comeback, that's, these things are going to fly. They're going to absolutely take off. So that's where you kind of confidence starts to build, and you're trading the situation back and forth. So this is really how the deltas move around a little bit. So let's take a look at the gamma profile again of our call on its own. So here's our gamma profile, right? So we can see that gamma is the highest at the money, right? So right almost at the money here, right? So what happens though if time passes? So let's do that. Let's take a look at this and go, okay, this is March 31st, right? We've got 3 months left in the lifespan of these options. Let's move that forward by a month and see what that looks like. How about on April 30th? I want you to watch this gamma. Look at the gamma here, right? It's trading around 85. And I'm going to fast forward a month. Look at first of all, look at my delta here. Okay, so we got a delta at 554. Watch what happens to my delta if we fast forward a month. And watch what happens to my gamma. We've got 3,300, 80. We've got 10,000 Vega on this position of 100 calls. Watch what happens as we move this forward by 1 month. Boom. Look at this Vega. Gets reduced significantly. My delta gets reduced significantly, right? Watch what happens here. If I go back to March 31st, my delta is long, 3,300, with the stock at 554. Watch what happens if I go forward a month. Let's take these one at a time. My delta drops. Well, that's what I'm talking about. They move through time and space. So as time goes on, this is an out of the money call, right? It's way above where the market's trading. It's not going to have as much delta. right? The delta is dropping on these calls. So as a market maker, I can't be short as much. So this is what we talk about when the market, you hear about the market has a charm effect. Well, that's if time's just kind of, if things are just kind of sitting around and market makers are short stock against these calls, what happens? You're going to hear somebody say, oh, we're going to move up on charm. Well, that means that basically nothing much is happening, and or we're just kind of moving around a little bit of a narrow range, and the delta on these is dropping, 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 dropping. So what if I'm short 3,300 shares against these calls? Well, I can't be short 3,300 shares anymore because I'm down to a 2,800 delta. These calls are only a 2,800 deltas at this point. I need to buy back 500 shares. So even though nothing's happened in the market except the passage of time, I now have to buy back 500 shares. That's a charm effect that is starting to push us towards this strike. Do you see that? The passage of time has created a bid in this market. The mere passage of time. So I hope you're starting to see how massive, massive option positions can start to have an effect on markets, right? And this isn't a huge one. I'm going to talk about the short game in a moment. But the passage of time is reducing this delta. What if we go back? What if we go to May 20th? Look at that delta drop again. So as time goes on, the delta is dropping, dropping, dropping because they're out of the money calls. Now, if we were on the other side of the call, if they're in the money, our delta is actually rising. It's going from 60 to 65 to 68 to 70. They're getting further in the money. And that has the opposite effect. So if I'm short stock, I actually need to sell more stock with the passage of time. Charm is having me sell stock, which pushes us towards the strike. On the below the strike, charm is having me buy stock, which pushes us towards the strike. So charm is conspiring to push us towards the strike, because if I'm short 7,000 shares against my in the money calls and the passage of time makes them a higher delta, now I'm going to have to sell more delta. I'm going to have to sell more stock against those. So charm is pushing us in here, charm is pushing us up here. So we have this effect that you're going to hear about where people are like, well, there's this effect, this charm effect, the long gamma is going to create a pin, right? We're starting to go towards that strike price to where we could potentially pin, because market makers are going to get less patient, right? With 2 months left, I'm going to let the market fly through this strike and give it some breathing room, because there's lots of optionality and there's lots of time value in these things. I have time to see what happens here. I can sort of look at the chart and go, you know what, I think the market's going to have a nice little run. But close to expiry, the gamma is going to be massive up in here, and I need to hedge as it goes through the strike price. So what happens during expiry week? Well, we have massive high gamma. During expiry week is when you have the highest gamma. So let's put these positions back in here just so you can kind of see the gamma as we get closer and closer to expiry. So let's take a look at now, which is our March 31st. We can see the gamma right up around here, right around this 50 mark, right, for this call, and down around below 20 on this short put area, 530 put. Let's see what happens when we go forward a month. Remember that, 50 and say 25. Now we've gone to May. Look what happens. Look at all the massive gamma. Now we're 120, right? Gamma has exploded higher where the long gamma is, and negative gamma has exploded lower where the shorts are, right? Where the short positions are. So what happens is, in a positive gamma market, this tends to kind of put a little bit of a clamp on volatility. Now, what's worth noting is that some people will say, well, there's all this positive gamma out there, and it's having a big effect on markets. Well, it may not be. If I'm far enough away from that strike, gamma actually disappears, right? It's going to be huge at the strike. But if we're far away, so last week we were around 5,800, 5,820. The 55.65 short put part of the collar was probably like, I don't know, like a 6 delta, 7 delta. It was very inconsequential. So it wasn't really affecting markets. Now, when we had a big plunge over Thursday, Friday, we got right to that strike. So suddenly we went from puts that were maybe a 6 delta to puts that are like 50 delta. That means market makers have to start selling into that sell-off. I'm going to show you how that works in a moment. But basically, gamma is very pronounced at the strikes. But if you're far enough away from the strikes, there's almost no gamma. So yes, it's true that gamma gets pronounced during expiry week, but not if you're way far away from it. If the SPY is up at 620, who cares? Like there's no gamma left in this 581 position. It's very, very low during expiry week. Watch, let me show you this. Let's show you expiry week of this position. Look at that. Massive, massive gamma right at that 581 strike. But look how quickly it drops off. As soon as we're at 610, 612, 615, there's no gamma. Zero gamma up here. Almost nothing, right? This position isn't affecting anything with the market up here. But as you get closer to that strike, gamma explodes. That's where market makers are going to be bidding all the way through the strike. So if you have positive gamma, the market's going to have a lot of trouble getting through 581 as it moves towards the downside. There's all this stock that's being bid against stock that was sold up here, right? Buying going on all the way in here and supporting the market. Look what happens on the short put. Massive, massive short gamma down here. So let's talk about that quickly. Okay, guys, so we'll stop here for today, and tomorrow we'll get into a short put dealer position and see how they stick handle that, and then we'll talk a little bit of charm and Vanna, and then that'll be it. See you then.